Comstock channel. My name is Brian Hendrickson. Today I have Joe Camp with us. Welcome.
Hey, thanks. Happy New Year.
Happy New Year. Thanks for being on. It is a new year, so let's talk about how things are looking so far. Even though we're a couple days in, how are we doing?
Kind of more of the same so far. I mean, it's a new year. That doesn't mean things have to automatically reset. Although there's some expectation that maybe we'll have a shift now that the calendar year is turned over. There are, things that happen when you have a new year roll around. You have different decisions that are made by hedge funds that are maybe reallocating some capital. Same with index funds. That could be potentially a source of support. Sometimes those commodity funds, when they have to reweight their portfolios, they're going to have to put additional capital into the assets or the commodities, in this case, that have underperformed over the last year. And that would include corn, soybeans, and wheat. Corn and wheat to a bigger extent down, I think, 24 or 25% for the last year. We've got soybeans down 6 or 7% for this 2023 calendar year. And so that's what we wonder if things will change on the investment or speculative approach to this market. But what's the same as what we're going to show here in this Brazilian weather map. It's all about Brazil weather at the moment in terms of the core fundamental influences for this market. And this is the 7-day accumulated precipitation map for South America. We see some of those red spots there in the center west or the northern areas of Brazil. You see that red spot there at the top. That's getting into that key Mato Grosso region. I mean, we're always keeping up with Matthew and what he's telling us about how things look. And, we know that the damage in some sense is already done, that they're getting close to really having the bulk of this soybean crop matured. And the dryness, the heat up to this point is going to take its toll in terms of what they'll actually produce. And now, if we get back to a drier forecast, which looks to come at the end of this month again, then that's going to be an issue for that second safrinha crop of corn that they like to get started on planting here soon. So it's lately, though, what's it look like now? And it does look wetter, and that's a change of pace from what we've seen here lately. And this links to the fact that we haven't had any export sales announcements pop up like we had come used to seeing here leading up to about 3 weeks ago. It was about 3 weeks ago that we had a daily export sales announcement for soybeans pop up every day of the week for 5 days straight. And then you had a couple of weeks where there was just one. So far here this week, this year, no daily export flash sales announced here. And so that's something that's ultimately weighed on the market. You bring up the nearby corn futures chart. So besides that Brazilian weather storyline, which is sort of a carryover of late last year where it shifted negative all of a sudden because we thought they were going to get some rain that eventually they did. Well, it just leaves it to being a technical trade of, the path of least resistance, as I keep saying, is lower because we have been in this big downtrend. The hedge funds have been short. They're defending those positions. And ultimately, we keep bringing up this nearby corn futures chart. It's the continuation chart where all of the front months are plotted. And that's why we have this gap there not long ago in December when the December corn futures contract expired. And so that left an area open on the chart that so far has sucked futures down into. And so we're still monitoring a couple of key price levels. The top of that range of expiration day for December futures was 460. So that's a point at which we could potentially find some buying interest. Maybe if that gap stays open like it did today, we stayed just above 461 for a low, then that could be a turnaround or a pivot point going forward. But beyond that, there's that other low here. The lowest level you can see on this chart was also for the December contract made in late November at 447. So these are really important spots that we're going to monitor. We think that now that we've gotten down to these levels close to 450 futures, we're at a point where, one, farmers aren't going to be active sellers. Normally, January is a month where they like to sell some additional bushels as the new tax year rolls around. But this year, they're not likely going to be as willing as years past when January prices may have been above or at least comparable to where they were during the harvest or just before. But you get to a point where fundamentally there's value to be had in this market. And that's why I think we can link it back to what we talked about with the lack of export sales activity and wonder if maybe this recent price weakness is going to start to spur some of that extra demand.
Let's talk about things we're seeing with the outside markets. How are they looking so far?
Right. So we had the negativity with Brazilian rain and a lack of exports, nothing really for the bulls to chew on. And so then we look at outside markets for the guidance, and all of a sudden, okay, the stock market's starting the year sharply lower. We had treasuries moving lower and interest rates rebounding back up. You had the dollar index coming up, like we show on this chart here. The red line having popped up from this recent low, which was around that really pivotal 100 mark on the index. And that is something that's negative for not only commodity export demand, because we know about that relationship where a stronger dollar makes our exports more costly to world buyers. As of late, it had made them cheaper as the dollar index was sliding. But recently, this rebound goes along with a bit of extra nervousness in these outside financial markets, and that fits too with the stock market moving lower and everybody just saying not so fast on being so rosy in terms of our sentiment heading in to 2024 here. So that's a problem. Also, an issue for the overall market has been crude oil, which started higher here on the first session of the year, but then turned lower ultimately. Today, back higher by a couple of dollars a barrel. I think that's what we can contribute the sustained strength in the soy complex to. Here today, a good rebound there. Not a runaway rally by any means, but that we stopped going lower after that big sell-off yesterday was a key spot. And we're going to keep watching oil. It's as volatile as ever, as we have a lot still going on in the Middle East. One interesting map that I've shown here is going to be shipping channels all around the world that you see in the green lines where we put out our goods and services goods on boats to the world. And you see one place I've circled in red is the Red Sea. And lately that's in the news a lot here. That green line of shipping traffic would be right now all but erased because of what's going on there in terms of these attacks that are being launched by the Houthi rebels. They're a group out of Yemen that are backed by Iran. And anytime, again, we're talking about Iran, that's going to be attached to the oil market because of how big of a producer they are. In years past, they've been a top 5 oil producer within that OPEC cartel. They've also been, among the world's top 3 natural gas producers. So if we're having an escalating conflict with Iran, that's going to be an issue that continues to be a potential disruptive influence for not only logistics, and this is something we're still watching. We've got the Panama Canal all but cut off still, maybe improving though, but low river levels there making it more costly. Now you can't get through the Red Sea, so we're adjusting how we're taking grain around the world, and that's worth watching. But the other item that we're going to keep in mind as an influence is just going to be simply the direction of the oil market and the fact that oil can be a leader for the commodity space, and it can still be attached to what we know to be an important link to the processing sectors with corn ethanol and soy-based biodiesel. So again, that oil was able to rebound today shouldn't be overlooked as a source of support for the gains that we had. And if it continues, I'd suspect that we've got more of a chance to see some bottoming action here for the grains after a little bit of a weaker start to the year.
All right, kind of wrapping up. Let's talk cattle. Good, bad?
Mostly good here. And that's what I wanted to wrap up with because of cattle showing some signs of strength here. And that's what I think is an example for the rest of the market, the grains included here, where, okay, it's not just about the technicals or the mechanicals. We don't have these outside financial markets as much of a worry in the cattle market. Instead, recently it's been that if the stock market's selling off, you got to worry about consumer demand, and there's selling in the livestock markets. But here the cattle are going up despite the stock market going down. And so that's where you have to get back to the fundamentals and acknowledge that we're still rather short supplied on cattle in general here. And that's going to be felt for some time here into the new year. Cash prices have shown a sign of rebounding here for cattle. And that's what we can get back to in the grains. Less of the outside market noise is as important as it is, and maybe back towards the core fundamentals. So cattle are an example of that. When I think about the core fundamentals of supply and demand, now I'm already looking ahead to the end of next week. That'll be the big January crop report. So more to come on that. We'll likely preview that next week, whether it's you and I or some of the other guys in the office. But that big January crop report coming up to maybe inject some fundamental attention back into the market.
Do you think some of that will play into what we see later on this week, finishing out the week and going into next week? Will that kind of play with the market some, or do you think, you said earlier, farmers aren't selling right now and stuff like that. So what all do you think you're going to see?
So we're still going to see the potential for some of that repositioning for the index funds, for the hedge funds. But as you allude to, we will have some focus turned towards this crop report at the end of next week on January 12th. And that's in part because here within the next day or two, we're going to have the trade estimates start to circulate. And we're going to think about where do these analysts view the numbers going forward. And that brings back into play Brazilian weather, because we know Brazil's going to face some cuts for production. But it also brings into play what the USDA will do with last year's U.S. crops in terms of yield and potentially acreage changes that can come on this January report. So kind of a quiet start overall, but we're about to see things really pick up in the lead up to that next Friday report.
All right, sounds good. Thank you so much.
Thanks. Talk to you next time.
You can find us on Facebook, YouTube, and TikTok.